Hey everybody, welcome to RE/MAX of Boulder. I'm Jay Kalinsky, I'm the broker owner here, and every month we do something for our clients, and we were talking to Dwayne and we said, gee, wouldn't it be nice if we could get a group of people together to do an IRA investing seminar. I didn't really know anybody, but Dwayne knows everybody. So we said, well, why don't we get together and we'll put something together for our clients. And then we were thinking, well, why don't we open it up to everybody and their clients? Because this is, now it's really relevant. So we just want to say welcome. We're glad you're here, and love to have Dwayne say a few words.
Okay. I met Bill and Catherine in the year 2003, which is now starting to be a long time ago. And the thing about 2003 was at the time, these two were fairly mavericks in this industry of buying real estate within your retirement fund. However, the interesting part was it's been okay to do this since 1978. So when I first learned that, I was actually very pissed off because I have a pretty good-sized portfolio, and none of it was owned in the real estate within the IRA. And there's so many advantages that you're going to learn about tonight in investing in an IRA. And so when I was president of the Boulder Board of Realtors in 2005, it became my mission to educate all the realtors that they could teach their clients to do this, because it is something that's totally untapped in our town of Boulder. There's a lot of people that do have enough money in their IRA to do it. You'll learn about how you can finance property in your IRA, which I think is a huge thing. So the thing that our mission is that, like, if you call your Charles Schwab broker or any of the financial planners and you ask, can I invest in real estate using my IRA? Still to this day, you get told no. Bill teaches an 8-hour continuing education class to CPAs because I've had clients call their CPA and say, no, you can't do that. And so, again, it's been okay since 1978. So we appreciate you being here tonight to learn about it, because it could be something that might not only affect you in your retirement, but also your children's retirement. So, Bill and Catherine, I'd like to start you off here, and you can tell them a little bit about your company and how it's grown and go from there. So,
great.
Thank you.
Thanks, Dwayne. So my name is Bill Humphrey, and this is Catherine Wynn, and we are the co-founders of NewDirection. And we started, actually, Catherine had learned about real estate as an individual investor years prior, and she had retired and had a rollover IRA. And she put that rollover IRA right where they told her, which was in the stock market. And she and I were running one day, and she asked me, why can't I invest in something that I understand, which was real estate for her. And I said, I'm a CPA and had been doing tax returns for 20 years and had never seen an answer to that question. So started looking, and lo and behold, and this was right around 2000, we discovered that you actually could, if you found a company that was willing to let you. And small chance that you'll find one of those on Wall Street, because they all want you to invest in stocks because that's what they sell. So we started investing with our own IRAs and learned the process as customers sitting in classes just like you guys are now and walking through the process. And then, like Dwayne said, in mid 2003, we got the opportunity to start NewDirection IRA. We started it just with the two of us, actually in my basement in Lafayette. And now, as of today, we have 78 employees in Louisville and about 1.7 billion in assets that people have moved to us. Now, the one thing about us as a self-directed provider is that we don't sell anything. So when you go home tonight, you're not going to have the package to sign and buy something, because it's going to be up to you. So with a self-directed IRA, all the decision-making always stays with you. So you are going to decide what property your IRA is going to buy and all the details about it. So what we don't do is sell anything. So we always have a disclaimer saying that anything that we talk about tonight is just for educational purposes to teach you how to do it, but what to do is up to you. So hopefully you'll go home with a good idea of how a real estate IRA works and some ideas to talk to your broker or real estate agent about and think about whether or not it works for you. So what is it? We call it a self-directed IRA because it is really you that decides everything. And it also is you that has to decide everything. So it's not for everybody because you're a key ingredient in the mix of the whole transaction. Unless you want to hire somebody, and you can always have a financial advisor or engage somebody to take care of it for you, but that's not what we do. We just provide the IRA itself and do the IRS reporting and writing the checks and sending the funds, anything that needs to be done for that particular investment inside the IRA. But if you want real estate in your IRA, you have to find somebody that will allow it. And most of them have self-directed IRA somewhere related to their name. So like For us, it's New Direction IRA, and we provide self-directed IRAs, and also other accounts, such as Roth IRAs, traditional IRAs, some 401k plans, even a health savings account could be an investor in real estate inside the HSA. Because the IRS surprisingly doesn't say what you can invest in. They just say, okay, we're letting you put this money aside for the future, and we're gonna give you some tax benefits in the meantime. But while the money's in there, they're not telling you what to invest in. It's always up to you. So, what we're gonna focus on tonight is real estate. And there are lots of ways to invest in real estate. I always like to think of the IRA as a separate investor. We sometimes call him Uncle IRA because we want to separate him from you, because really it's his money that's being invested in the property. So Uncle IRA as the investor could invest just straight up buying the property himself. In that case, it would be titled directly to that particular IRA. So for our clients, it's New Direction IRA, FBO, Fred Smith's IRA. Just like the account from Schwab and Fidelity, same titling. We want to make sure that it doesn't look like it's yours, because we want it to stay inside the IRA. So the titling is really important. So when you're getting ready to write a contract, it'll be that IRA is the investor. Sometimes Uncle IRA doesn't have enough money and wants to find other investors to go in with. So that's actually how Catherine and I started. Our first investments were apartment buildings in Denver, and we didn't have the $3 million that was required for that particular apartment building. So we rounded up some other people, and each of those individual investors, some of them were IRAs, some of them were not, but we all went together and bought the property through an LLC actually. So it was a bunch of investors taking their smaller IRAs and pooling them together to make the investment. Other things that some people don't want to deal with the hassles of IRAs. I mean, not of IRAs, of real estate ownership. But they know how it works, and other people want to buy the real estate, and those people sometimes need loans. Sometimes for like fix and flip properties, you might have your IRA actually be a lender to someone else who is interested in buying real estate. So it's not just straight ownership, it's all sorts of investments related to real estate your IRA can be an investor in. And the most common thing, like our example again, was investing in an entity that is going to then invest in real estate. So you could go in as tenants in common ownership, or actually have those individuals form an entity like an LLC or a corporation. So all of those transactions possible for Uncle IRA because Uncle IRA is an investor. The key thing is, does he have enough money? How much money is it going to take to make an investment? And it can be all sorts of different levels of investment. But a lot of people, and Catherine included, wanted to buy an investment that they understood. She didn't want to learn about real estate. I mean, she knew about real estate. She didn't want to learn about the stock market because it seemed like it went up and down just when somebody blinked. And she didn't understand it. She couldn't drive by it. She wanted to actually see it and understand how it works, understand that there's appreciation potential, particularly around here, that whatever you buy is probably going to go up over time. And in the meantime, it's going to generate some cash flow to come into the IRA, because the IRA is the investor, so that money is coming into the IRA to grow it, just like a dividend would from IBM. So everything that's happening inside the IRA is just like the Wall Street ones, except for the asset in there is different. For some people also, they want to have a wider variety of investment choices. So a lot of our clients still today will have a stock market account, maybe at Fidelity or Schwab, then they'll have a New Direction account that invests in real estate and other things. And feel free to ask questions as we're going along. So I'm going to go through the sort of the big picture piece first, and then we're going to walk through an example. Yes, Jay?
So could you have your HSA and your self-directed IRA buy a property together? If you had two buckets of money, could they go together to buy or invest in a property?
Yes. So the question was, if I have a bunch of accounts, so like you saw the list of choices, some people might have all of those, and they might have money in each one, and they want all of those to go together to buy a property. And yes, they each have a separate account, but they are each an investor that can partner with, even with your own accounts. And there are some special rules we'll talk about with regard to family members. But for example, my HSA and my simple IRA and me personally and Catherine personally own shares of or an interest in a condo in Maui. And we each, there's a property manager who divides up the rent and splits it among the 4 owners, just like any other property manager would do with multiple owners. So the key thing in that example is each one of those accounts is separate. So it's a separate Uncle IRA or Uncle HSA or whatever.
The 401k, is that going to be subject, what are the rules around that? Do you actually can you do a non-taxable distribution as long as you roll it into an IRA, or is that really up to the company that's controlling the 401k?
So unfortunately, the company, if you're still working for a company and have a 401k there, they write the rules. And generally, they write the rules so that you can't take it out until you either retire or change jobs. But some of them will, and as time goes on, more and more of them, I suspect, will, because they don't really want to be offering you investments either. So, yes.
I think a lot of them, if you're still working for a company, a lot of them at 59 and a half, you can move it.
Good, yes. The portion of it that you contribute out of your salary, you can immediately at 59 and a half take out and roll it into another IRA. So it's important not to touch it. You move it straight from that 401k to an IRA.
So with the HSA, can you continue to contribute to your HSA?
Yeah, so the idea of an HSA is for health expenses.
Right.
And what a lot of people don't realize is that you don't have to pay immediately your health expenses when you incur them. You can go to the doctor today and pay that bill out of your pocket and then reimburse yourself out of your HSA in 20 years or whenever you decide. You can only make contributions to an HSA when you're 65 or under or prior to going on Medicare. So you need to be covered by an HDHP or a high deductible health plan, and then you can make a contribution to the HSA.
And then one more thing, on rental property, if you have rent coming in, you can't get it, it has to go into the IRA, but then you can, at 59 and a half, you can start taking withdrawals out of that?
Correct,
IRA?
correct.
Okay.
So the important point, anything that Uncle Ira buys, Uncle Ira gets all the benefit and all the expenses related to. So when Uncle Ira buys real estate, he gets to pay the property taxes and the insurance, and he gets to collect the rents. But they come into his bucket. They don't go into your pocket because it's a separate person or a separate entity. All that is going on inside the IRA or the HSA. And your goal is to make it be the biggest IRA you can by the time you need to start taking money out. You can always take money out early and pay taxes on it and potentially a penalty. But the idea here is to grow that account as big as you can. So real estate being sometimes a better option than Wall Street, particularly for people that understand how real estate works. So just to reiterate that separateness, the Uncle Ira idea is not just for a name, but it is to get into people's head that it is a separate person, a separate entity that's making the investment. Because people have a tendency to think of that money as theirs, but it's not really until you take it out of the account. You control it, but it's separate because the IRS has given you special tax status for it while it's in the account. Yes.
Maybe you can answer this question later, but if I have multiple IRAs, can I roll them all into that one? And if my wife has more than one, can that all go into one?
So
Into Uncle?
all these plans come in the different flavors of traditional and Roth. Any Roths that you have can be combined into one, and any traditionals you have can be combined into one. But you'll still have two, one Roth and one traditional. So those, like Jay was saying, are separate investors. They can partner together, but you have to track them separately. So for us, on our side, we see two different accounts happen to be investing in the same thing, but you're controlling both sides. And a lot of people too, when you can move money back and forth between, so if you have a Fidelity account, for example, with $100,000 in it, and you have a NewDirection account with 100, you can transfer cash between the two without any tax consequence.
And the husband and wife thing?
And the husband and wife thing again, so you would have his and hers, and each of you might have 2 or even 3 if you had an HSA as well. So, any of these documents, since Uncle Ira is a separate person, who signs for Uncle Ira? That's our job. So we execute documents on behalf of that IRA. We, as the administrator, are between you and the money. So we are sending money out, receiving money in, and doing all the paperwork for it, and we execute documents. So at closing, the name on the settlement sheet is New Direction IRA for the benefit of Joe Smith, and we sign as the authorized signer for that particular IRA. So that we're still in the mix, but we're not looking at the documents to make sure it's right. We leave that to you. So, someone out there is thinking this is great, I'm gonna have a condo in Maui and go stay in it. Well, the IRS unfortunately thought ahead. So there are rules about what you can't do. And the biggest one is that this is Uncle Ira's money, and you don't get to touch it until you take it out and pay taxes on it. And that includes whatever Uncle Ira buys with the money in the account. So if Uncle Ira buys a condo in Maui, which is fine, you can't go stay there. So no transactions between you and certain disqualified persons and Uncle Ira or Uncle Ira's assets. So one of the sheets that we handed out, there's a little chart on the back that talks about these people that we call disqualified persons. So it always starts with you plus your spouse, and any children, grandchildren, any of their spouses, parents, grandparents, any lineal ascendants or descendants of you. So none of those people can go stay in the condo in Maui, nor can any of those people be involved in the transaction where they're selling or buying from Uncle Ira or vice versa. They can partner together because they're not having a transaction with each other. So in your case, you have 4 accounts, you want to buy a property, all those 4 accounts are buying their individual slice, they're not buying it from each other. So it's possible for people to partner but not have a direct transaction with Uncle Ira. If you go home at the end of the day and some of Uncle Ira's money is in your pocket, that's a warning sign, because that's not allowed. So any of those are called prohibited transactions, and we want to avoid those. So also if you happen to have a condo in your IRA in Boulder, and you happen to have a child that's going to see you, they can't stay there or rent it, regardless of how much they're paying. It's just a line the IRS has drawn, no transactions between any of those disqualified people and Uncle Ira. Because for some reason, they think Americans might be schemers with regard to taxes. I don't know if that's true or not, but.
Isn't it also correct that no one in this disqualified group can replace a refrigerator or fix a broken anything? Is that correct?
Yes. So in addition, a transaction could be services. So no services provided to you from yourself to your IRA, such as the house needs a new garage, you happen to be a carpenter, you cannot go and build the garage for it. But you're still in charge of everything that happens. So you can cause it to happen with Uncle Ira's money by selecting the contractor, keeping an eye on it, making sure they're doing the right work, quality work, and painting it the right color and renting it to the right tenant. All that decision making is still yours. You just can't go and add value to it because the rules say you can only make certain contributions to your IRA, the $5,000 or $5,500 a year. That's the only contribution you can make each year into Uncle Ira's pocket. Above and beyond that is not allowed. Yes?
So if your dream retirement home is a condo in Maui, for instance, and you want to buy that at today's prices because you're not retiring for 10 years or something, and then you get to that point, how does it work with, because then you need to pull it out. Is it pulled out at, like, because you're not, do you have to, how do you get that property? Can you get it back? Because you said you can't sell it to yourself, so what happens even though it's your money?
So it is Uncle Ira's property, and we have this discussion anytime we travel places. Property seems to pop up everywhere we go. Oh, what would that be like? But condo in Maui, you found your dream condo on vacation, you think you want your Uncle Ira to buy it, and 20 years from now you're going to retire and you see yourself sitting on the lanai. And, certainly possible, while it's in the IRA you can't use it, but you can keep an eye on it. And then once you get to retirement, you can actually tell Uncle Ira to deed that property out to you. It comes out at the current value 20 years from now. If it's a traditional IRA, then it's going to come out taxable to you. If it's a Roth, then it comes out tax-free. So ideally, you would convert your traditional to a Roth today, buy the condo in Maui tomorrow, then when you get to retirement age, Uncle Ira has been collecting rents, paying the bills all that time. He's going to give you that as soon as you tell him to, and you can move in at that point.
So Bill, if you had a goal of like owning the whole condo yourself in 5 years and you had it in a regular IRA that was gonna be taxable, can you actually disperse a certain percentage each year for 5 years, so at the end of 5 years, it's all out and you've spread out the tax burden?
Yes, you can either do a conversion each year by slices, or you can take it out. If you take it out and take ownership personally, then say 20% the first year, then 20% of the bills, 20% of the rent would need to come to you, and that would start showing up on your own personal return. Yes?
And then that same process would happen when you're required to take minimum distributions. You would have to take, you wouldn't have to sell it, so it's like you could just take like the fraction.
You could, and we've talked about it a lot.
We've
but
had people do that.
The paperwork is more, obviously, because you have to first get the value. So generally when it's a taxable event to you, we'd like to have a formal appraisal done so that we can show the IRS and you can show the IRS what the value was. Once we establish that value, then you determine how much of that you want to take. Then you can quit claim deed 20% plus the related value out to yourself. Or at RMD age, lots of people, these properties are producing cash flow in. It's easier to take cash out than a sliver of the property, but either one is possible. Planning is important though. Yes?
So if you took a portion of that, then you could stay a portion of the time.
You would hope so. But no, because
Dang.
it's a ownership of everything. So you don't own the bathroom. They don't quit claim the bathroom to you, so you can gradually take over more and more
So you
space.
can't have 20% ownership of the whole entity.
Correct. You could have it, but you still couldn't use it because the other 80% would be attached to the 20.
But you couldn't use it 20% of the time.
No, not at all. Right. Sorry. One part of my job is to burst a lot of bubbles. Years and years.
Could you do a 1031 exchange within that?
We'll get to 1031 exchanges in a little bit, and they can come into play for IRAs, but not in the situation you're thinking probably. Okay.
Titling?
Another bubble bursted.
Titling. So again, when you drive home tonight and you're looking at a suddenly, well, I don't know how many properties are for sale around here now. I guess there are more now than there have been in the past. But as you see the sign and you look at it and think, I wonder if my IRA could buy that. The answer is probably yes, if your IRA has enough money. If not, then go home and call your friends, because their IRAs and your IRA might have enough money. And then we'll also talk about the idea of borrowing inside the IRA. But the most important thing on our primary thing that we're looking at on the document, when you get the closing document ready, or the title company does, and they send it to you to look at, you're looking at all the numbers. We don't care about all the numbers from our side. We want to look at that titling line to make sure that it's actually Uncle Ira that's going to own it at the end of the day, not you personally. It's an obscure point, but it's the most important, because if the IRS looks at that document, they're going to make sure as well that Uncle Ira owns it or not. So the titling for our clients, NewDirection IRA Inc., which is our company as the provider of the IRA, just like Fidelity provides IRAs in the stock market. FBO, which stands for the benefit of a particular account. In this case, we would use client name, so Joe Smith, IRA. Could also use Joe Smith's IRA account number, but that's the name that's going to show up in the county records. So if you do a search on NewDirection IRA as an owner, you'll find lots of names, because all of our clients are titled that way for their particular real estate investment. Earnest money, lots of times is required, almost every time, and that has to come from Uncle Ira too. But remember, going back, there's no transactions between you and Uncle Ira, including any advances of cash to help Uncle Ira do something. So Uncle Ira needs to have the cash for the earnest money, Or there needs to be a willing seller that'll wait for it to be transferred into Uncle Ira's account, or maybe a note issued or somebody else that's willing to front that money for Uncle Ira. The easiest thing is, as you drive home tonight, as soon as you get home, go online and open Uncle Ira's account, get some money in there. Even if it's only $10,000 or $20,000, just for that earnest money so that you're ready when the time comes to make an offer. The offer itself shifts over to the real estate person, because at that point it's just an offer. It's that transaction process for buying real estate in an IRA is still a real estate transaction with all the stack of paper at closing and all the inspections and all of that work that you would do to buy any investment property. That's all still happening. It's just happening in Uncle Ira's name, and Uncle Ira is paying the bills.
So you can't, if you have existing property, you can't claim it into this.
Correct.
Can you?
No.
Can the uncle buy it from you?
Nope.
No? So you,
Bubble,
so you, whatever you have, you're stuck with.
Whatever you have, you're stuck with.
Okay.
But Uncle Ira can buy similar stuff. The one across the street if that one's doing really well, or not buy the one across the street if it's a loser.
So how long does it take to set up the IRA? Because obviously you're probably not gonna set up an IRA unless you have a property in mind, and then you have to have the cash in your existing IRA and able to be able to transfer it in. So how long is that process?
So to open an account with us, you can actually go online and in most cases get an account number and be ready to go in 20 minutes.
Yeah, we have a
Formally
slide on
getting-
that.
Oh, okay.
Yeah, so we have a process slide.
Yeah, it's fast to get it open. The slower part is getting Fidelity to send the money over, and that's usually a couple of weeks. You can also, because this is an IRA, you can also make your contributions to that IRA. So from now until Monday, you can make, if you haven't made already, last year's contribution plus the 2017 into the IRA. So you're starting with 11,000 in there, maybe more if you happen to be older.
So how would you handle the earnest money portion of that if you don't have the funds in the IRA to do it? Can you do it and be paid back at closing, or?
So you personally can't be paid back, but so you need to have someone, and Catherine, maybe you can describe how people deal with not having cash.
Sometimes you can do a promissory note, which in the current market doesn't work as well. We've had friends step in for friends and make the earnest money payment, and then they can be reimbursed after the closing by the IRA. And then the annual contribution is probably the best one because you can have that available almost right away, even if you don't have your funds from Fidelity or whomever.
Right. So with moving money from one to the other, there are two choices. The first one, and the easiest one, is to fill out a form, send it to us. We send that form to Fidelity, asking them to send the funds to your new account here. That's the one that takes 2 to 3 weeks. Or you personally can call Fidelity and say, hey, I want to take money out and send it to New Direction. They will do that usually, depending on what it's invested in, usually 2 to 3 days. They can wire the funds in. And that one, you can only do one time per year per person. And so if you're going to do that, remember that any future transfers have to go via the transfer route. So we have actually had somebody open an account on Monday, wire funds in on Tuesday, and have a closing on Friday of the same week. That was a rush. But it worked really well for them. The more typical example is open the account, get some money in there, or all the money that you're planning to invest, and have it waiting there and ready. So while the money is waiting, it's not earning anything, but it's ready to go, FDIC insured, or you can invest in something else here. So it's not just real estate. We do have people that open brokerage accounts while they're waiting inside their self-directed account too. So thinking about debt, when we came here in 2003, there weren't any lenders anywhere who could even pronounce IRA. But since then, we've been very lucky, particularly in Colorado, to find some lenders, including First Bank, who will actually lend to Uncle Ira. And when they do that, they're giving Uncle Ira a lot more buying power. So Uncle Ira that has $150,000 could go buy a $150,000 property with cash, and that's the way our early clients did it, because there wasn't any financing choices. Now, with what's called non-recourse lending, that same $150,000 can buy up to around $450,000. So suddenly your IRA can go out and make a purchase that's much bigger than the cash that it has, with the obligation to pay it back. So Uncle Ira is the borrower, and Uncle Ira has to pay the mortgage back to the bank. The loan is secured by the property and not by you. So it doesn't show up in your credit rating, it doesn't show up anywhere other than in Uncle Ira's name, because Uncle Ira is the owner. The bank, in order to lend to you, wants to know a couple of things, usually. Who are you? What have you done? What do you know about real estate? Sometimes what your personal credit rating is, just so that they know something about you. But you're not going to sign on the loan to commit yourself to pay it back because it belongs to Uncle Ira. And thinking back to the transaction between you and Uncle Ira slide, it makes sense because you can't have a transaction including co-signing on Uncle Ira's loan, because that would enable him to do something that he couldn't do on his own. So in most non-recourse loans that we've seen, and First Bank is probably the primary lender around here, although there are more smaller banks that are starting to do it. There are a couple of national lenders whose names you wouldn't probably recognize, but in Hawaii even, but nationwide, there are non-recourse loans available. Most of them require at least 35% down, sometimes even more depending on the property. And we'll go through an example of what it might look like to the bank and to you for your own IRA of how that transaction works. But the nice thing is that leverage does give you a lot more buying power, and even if you don't have a whole lot of cash flow coming from it, you are still having the loan paid by the renter, and you're buying into that future appreciation. Yes?
Are you still gonna want a certain amount of liquidity after the purchase?
Probably would be a good idea.
The
Again,
lenders would require that, I would imagine.
Actually, they don't,
they don't. It's
which is very strange.
Yeah.
Do you find them more attracted to commercial or residential properties?
The non-recourse loans are usually for residential. Most of the bigger loans are going to be in the commercial category, which puts it into a commercial category at the bank, which there are different requirements from the banking side. But we have had people come in to buy like a strip mall, that big dollars, and lots of investors usually going in, because our average account size is about 85,000. And the average for real estate transactions is probably closer to 100 or 125. But take a bunch of 125s, you can buy a pretty big property. So, but far and above, most of our clients are not partnering with other people because they want to do it themselves or with certain family members. Yes.
You talk so much about partnering, but what happens if somebody says, you know, I've had hard times, I need to cash out my IRA, I've got to get rid of my portion of that, but what happens to everybody when they're in that situation?
Well, interestingly enough, Catherine has a story about that. So you can describe your buyout of the.
Oh yeah, recently have a property on the hill at Euclid and 13th, and have owned it for a while. And I'm a 40% owner personally, and there's another 40% owner, but the 20% person wanted to be bought out. She needed the money. And she came to her partners and asked, do you want to buy it? Well, I mean, nobody really wants to be in a partnership with somebody they don't know. So we thought, how are we going to make this happen? And while I was thinking about it, I realized that I had an IRA that had the cash in it. So what I plan on doing is using that cash to buy 10% of the share, and my other partner who doesn't have the cash, my IRA is going to lend him 50% of it. So we're able to buy her out, help her out, and using my IRA as both a lender and a purchaser of that last 20% of that building. Yes.
Can you buy that from yourself? Aren't you a disqualified person?
No, because we're buying it from the partner who is not me. Yeah, so we're buying.
How do you set the buy price?
Pardon me?
How do you set the price?
She had an appraisal done. Yeah. I mean, that's always part of the negotiation and, in any purchase, but she had an appraisal.
So you can be an owner individually in your IRA?
That's right.
Percentages?
That's right. And the key to this really is to make sure that going forward, that there is money kept in the account in case, say, the roof blows off or something. Because the IRA does have a limited ability to cover expenses at times. So going forward with an IRA involved, at least for the ownership portion that my IRA has, we have to be careful that we don't distribute 100% of all the cash as we go along.
So the short answer is it depends on the partners. But in Catherine's case, she had other investors who happened to be her Uncle IRA that could come in and help, in her case, buy out that share from the other partner. But going back to your question of bringing a bunch of people together is you get partners and stuff happens to them.
Yeah.
How do you protect yourself in the event the rents dry up, taxes need to be paid, and the bank is headed for foreclosure?
You try everything you can. Just like any other investor, you'd probably try and bring in somebody or get a loan. So in one of the properties that we started with in Denver, and we bought at absolutely the worst time in Denver, and immediately after buying, the rents and the property value went down. We had cash flow issues, so we, like in Catherine's case, looked for other investors who could come in and make loans. We found somebody short term that would charge an arm and a leg and make the loan to us. But it's important to think, this is an investment. Is there enough money, and how much reserve do you need and should you have?
You said the loan to us, you meant the loan to the IRA.
The loan to the IRA, right. Yes.
Can you distribute, if it needs a new roof and there's a $5,000 shortfall, can you just make that distribution under the annual contribution to an existing IRA with you?
Yes. So if you're short, and that's one of the things we always say, make that annual contribution because you never know. It's an annual window to dump some extra money in the account, and it does add up over time. And just being careful, of all the transactions we've had, and probably close to 1,000 debt financed ones at this point, I think we've had 3 that have gone completely south. And one of them was somebody that got in without realizing how much work it was, being a manager and keeping track of it. And he kept moving more money into the account and still no tenants, and damage would happen, and he finally ended up, he couldn't put any more money in, and he turned it back over to the bank. And his investment went to 0. But on the other side, been many that have been very successful with it. But it is a risky, any investment is risky, and managing it and knowing how to manage it is important. Yes?
So I may be getting ahead of you a little bit here, but if you're using your IRA as a partial owner into a property, and so you set up an LLC to do that, you're not required to distribute the money out of the LLC at any given time. It's up to the managers of the LLC to decide, as long as we keep it in there. So
Right.
you could pool liquidity within the LLC.
Right.
Just when you distribute, you have to distribute proportionally, is that right?
Right. So, before we leave this one, there's a little line there, the last line, taxes may apply. So I won't spend much time on it, but just be aware that the IRS in its cleverness has said that, okay, we're allowing you to put annual contributions in, but if you take that money and have Uncle IRA borrow, then a portion of the profits from that investment that you used borrowed money to buy will be subject to taxes. And it's just like your own Schedule E, it's after all the expenses, including depreciation and interest and maintenance and all that stuff. So lots of our clients, even though they have debt and they have a return prepared for Uncle IRA, discover that Uncle IRA has a loss because of depreciation, and those losses carry forward to offset taxes. Most times, unless somebody has done spectacularly well with an investment, the first 5 to 6 years, there's losses accumulating, and then starts to be some minor income tax for Uncle IRA, which he pays going forward. The bigger number happens when the property is sold, but you have the option of paying off the property early, and if the property is completely paid off 12 months prior to sale, then there is no tax due. So lots of opportunity for minimizing that. Most of our clients are shocked, like I see some faces out there, that an IRA would actually have to pay income tax. It's not known very often, or not known by many people, because they've never had the opportunity to borrow any money in their IRA. But it's been there since IRAs came out in '78. So it's not new, it's just an unusual feature. And if you don't want to have your Uncle IRA pay tax, then don't borrow. If you want the extra buying power, then know that it comes at a potential cost for the IRA. But in most cases, it's coming out of extra profit that is there because of the borrowing in the first place. And we'll go through a quick example if we have time at the end. So here's the process. Open the account. We launched our online account process 2 years ago, so you can actually go online to newdirectionira.com, put in all of your new account info, your name, social security number, beneficiaries, all that stuff, just like you would at the bank or at Fidelity. Get the account open. Your next thing is to get money in there, so start the transfer or rollover process. For lots of our clients, they're leaving an employer and they're rolling that money into their IRA, so that money comes from the IBM 401k plan or whatever straight into their IRA. And that usually happens within 2 to 3 weeks for most people. But in the meantime, you know how much money you have to spend, and you call your local real estate person and say, okay, I'd like an investment property in this price range, what's there? And they hopefully will come up with a few options. Some in Boulder, some not. Some more expensive, some less. But you also want to say, well, you're thinking about a loan. If you're thinking about a loan, then remember that 35% down, because that's probably the minimum, and it could be higher depending on the cash flow from the property, because the bank wants to make sure there's enough money coming in from the rent to pay the mortgage. So as you're looking for that, remember, this is an investment, and the decision maker is you. So everything that you would do to spend your personal money to make an investment, do for Uncle IRA. Things like looking to see what the neighborhood's like, what the appreciation potential is, what's the rent gonna be, what are the maintenance expenses gonna be. All of that stuff, do the same thing for Uncle IRA. When you have decided, make the offer. If you are gonna get a loan, you probably should talk to the lender. First Bank will actually issue a pre-qualification letter based on your account balance and what their requirements are for cash flow. At that point, it's just another real estate transaction. Title company is going to issue that same stack of documents. You're going to have to look at it to make sure it's got the right numbers. We're going to look at it to make sure it's got the right name. We're also going to look at it to make sure that you approved it. So on all those papers, we want to make sure you read it first. So you write read and approved down near the signature line, send it to us. We put our name on the document, send it off to the title company along with a wire for the funds. And the next day or two, or sometimes 3, closing happens and suddenly your Uncle IRA owns a property. Yes?
Now, often banks in Colorado don't like to loan on property outside of the state. If you get a loan like this from First Bank, say that really doesn't like to do things outside of the state, are there the same kinds of restrictions on purchasing income property out of state?
Yes, depends on the lender. So First Bank only lends in their trade area.
Mm-hmm.
So Colorado, some in Arizona, and some in California. What is it, Palm something?
So you just need to find a bank
Right.
outside of the state, wherever you're going.
Right. So those 2 national lenders that I was talking about would be the next call. Or if you have a bank, then have a good relationship with them. Even we've seen a loan from Wells Fargo for an IRA. That particular person had a bunch of other money at Wells Fargo and they wanted to make him happy. So they figured out how to do it.
Mm-hmm.
But in general, the smaller local banks that lend to people that they have a relationship with are the best choice. The 2 national lenders will lend anywhere. They tend to charge a little more in interest. Most of those non-recourse loans are the rate is what you would expect for an investment loan. So it's not going to be the personal residence rate, it's going to be the extra half or 3/4% higher. Typically, all of that is worked out between clients and the bank. So we're not involved, but in general, I'd say we've seen rates between high 3s and 5s for IRAs. Okay, so you're at closing, suddenly Uncle IRA has an investment. What about the bills? Well, Uncle Ira has to pay him. So Uncle Ira's got money, hopefully, a little left over in his account with us. That money can be used to pay the bills. Hopefully the rent will start coming in soon. So the rent will go into that same account. You can actually go online and direct us to send a check to the HOA or the county tax assessor or the handyman, whoever you direct us to pay the bill to. Or you can even send us the bill for a little extra charge. We will process it from the paper version. Or if you wanted to have a property manager in place, you can engage a property manager. The client is actually the IRA, but the manager does all the manager stuff, including paying the bills. At the end of the year or the end of the quarter, the manager would send whatever is left back to the IRA. So all the normal things that happen with a rental property are going to happen with Uncle Ira's ownership, but the money is going to come from Uncle Ira and not you. So again, keeping that distance between your money and Uncle Ira's money is important. So the do-it-yourself management, if like in a condo where there's not really a whole lot of interaction required, lots of our clients will just do it themselves. So they have the number for the plumber and the number for the handyman, and if the client or the tenant calls them, their next call is to somebody to go out there and fix it. The bill is paid by the IRA. If you happen to have your Uncle Ira buy a 40-unit apartment building, there's probably a lot more work to do, so you really start to need a manager to do it. Because if you're answering the phone once in a while and directing, it's a lot different than being there 24/7 and keeping an eye on it. So the more you get, the more you're pushed into having a professional manager. Yes?
Sorry. So I asked before, you can have individual ownership as well as your IRA having ownership in the property, but then does the line get blurred as to what you're doing as your individual versus the IRA and managing that property?
So the decision making is always yours, whether it's you or your Uncle Ira. So there's no question on the decision making. But if you're an on-site manager that likes to go and tinker in the furnace and do that kind of stuff, not a good idea to have that property owned by your IRA and you personally. So there is a line, and that's providing services line. So if you do it too often, then you're probably crossing the line. If you do it enough to worry about, you're probably doing it too much. But for most of our clients, they have a unit that doesn't need much interaction, and there's not an issue. If you have a bunch of them, or if you have one that has a lot of units in it, then bring in somebody else.
I think it's important to note that the rules of these are written very broadly, and we have to rely on court cases and opinion letters to find out where the IRS is looking and what they're looking at. And I guess in the last 14 years, we have always hoped to see something on providing services to the plan. And they've had the opportunity to rule on that, but they have always avoided it. And we think that they're really not prepared to draw a line either. So every individual has their own tolerance on how much they will do, how much risk tolerance they have. We don't police that.
Right. And I find as the years go on, my tolerance for wanting to do it is kind of tailing off. But, just call Fred. Send him out there. You all have a listing, hopefully. So when we got here tonight, we asked Mindy to pull a listing somewhere in the price range of $300 and less to have us a sample. So this property, which is in Boulder, is priced at $235,000. So we're imagining that Uncle Ira has $100,000 reasonable size IRA, but it could be a combination of multiple accounts. It could be an HSA, individual, traditional IRA, or a Roth IRA, but the combination of all of that cash is $100,000. So we looked at it and said, okay, what would this rent for? And we asked Dwayne, and he thought, oh, 900, maybe you could push it to 1,000. So we've got, and this is a studio, so, but remember it's in Boulder. So 235,000, and it's gonna rent for 1,000 a month. So one of the nice things with this listing is it has the property taxes and the HOA fees. So you can guess that probably this condo is not gonna need a whole lot of maintenance because there's not that much stuff there. So probably your reserve could be a little less. So we started with 35% down. And, okay, so that mortgage payment at 3 3/4% was gonna be $752. And the HOA was $152 a month. They have a pool. It's important. Put that in the ad. And then taxes, $81 a month. So those are the mandatory expenses. So you've got 1,000 coming in, 752, 152, and 81 a month going out like magic. There's a whopping $5 profit. So what's the bank going to say about that one? Probably not going to work, because the bank's going to look at this and say, okay, we don't know if you're ever going to make another contribution to your Uncle Ira, and we can't make you make a contribution. So we want to make sure that this number is enough to cover the mortgage with a little room to spare. And what First Bank does is ask for the cash flow from rent to pay all of these plus an extra 20%. So this one's not going to cut it. But remember, it's Boulder. You're buying something that's worth $235 today. What's it going to be worth in 5 years, Dwayne?
Yeah, well, at least 10% a year, right?
Right, 10% a year historically. But hopefully when you're buying this property, you're thinking not the rent, but probably more appreciation. And that's just the market here. So it could be different anywhere. If we'd gotten a property in Broomfield, completely different perspective, but you can see that this one is a challenge for an IRA, at least with 35% down. Question?
That was it. So if you just, they might say raise the amount that you're putting down to get that cash flow.
Right. So we went home sad, came back the next day and said, what if we put 40%? Because Uncle Ira has 100,000. So this 35% would have only been about 80, but 40% would have changed this payment number to be only 652. So now we're at 105 per month. So we're getting into that range of, okay, this is starting to make more sense. And it gives you some cash flow in the account to make those repairs or anything that, when a tenant moves out, fix up things. So it is building some cash flow for reserves, and it's still in Boulder and going to appreciate, hopefully. And in the meantime, the loan is being paid off by that tenant paying the mortgage down. So this is based on a 30-year loan. Most of the lenders out there will do 30-year AMs, but a lot of the rates are variable after 7 years or 5 years. So they're locked in. This one is starting at 3 3/4. All of a sudden you have a property that might actually work in your IRA and might get some cash flow, and suddenly you're building for the future. So any listing that you find, you can first start with how much money does your own IRA have, look at the expenses, see whether it makes sense or not, and if this were a fix and flip property, the bank is not going to want to lend on it, because the First Bank anyway is thinking that they want to have this loan for a long time. There are lenders out there that would lend on a fix and flip property, but usually the rate is 10 to 12% instead. Can be profitable. We do have clients doing it. When somebody is doing fix and flips, that is actually running an operating business, and any profit from that fix and flip could be subject to income tax inside the IRA. Not the end of the world, it's just another expense to consider when you're doing a fix and flip. Questions on this? Yes?
Who pays the administrator fee, the IRA or the holder?
So the administrator fee is optional to either one. So somebody has to, but either you or the IRA. So, and that can change at any time. About half our clients pay it from the money inside the IRA just for convenience. Other people want to pay it personally so that they keep more money inside the IRA.
You typically set up a separate IRA for each property if you have multiple properties, if you're borrowing?
Generally, our clients don't. Some people do to keep them separate for liability purposes, but in most cases, and particularly when there's debt, it's an advantage to have multiple properties in the same IRA, because One of the things with calculating the tax is the debt ratio on each property. So you can actually manage the ratio between the properties to minimize taxes. And going back to your exchange question, if this property is held for 5 years and then sold, the IRA can actually do an exchange of that property into a new one to defer any taxes. So remember I said on a sale the taxes were the highest. Those taxes can be deferred through an exchange just like anybody else. So lots of interesting stuff that you probably haven't thought of, but a lot of stuff that you already know because you know something about real estate. It's just happening with a different pot of money, and your goal is to make that pot grow as fast and as the most that you can. So a lot of our clients think that real estate is a much better thing than the stock market, or maybe lending. Anything that doesn't happen on Wall Street can happen inside a self-directed account.
I have a question.
Yes.
Let's say you've got a pretty nice IRA or Roth IRA and you have enough to pay cash for the property, so almost all of the rent money is income.
Right.
But is there a certain amount you can only deposit every year into your IRA?
There is not. So the difference is you can make an annual contribution out of your pocket and into Uncle Ira's account, and that's the one that's limited. But once it's in there, whatever Uncle Ira invests in can make as much money as you want. Yes.
So on distributions, at, what, 70.5, I think?
Right.
I know one way you can you just take rental income out.
Right.
But let's say there's not enough rental income to meet the requirements of the distribution.
Right.
So what are your options?
Well, then we go back to taking the sliver of the property out in kind. Fortunately, you can only contribute cash, but you can take out stuff in kind. For a lot of our clients, that cash flow, particularly if there's no debt, imagine this one even, you take out the $752, then you're up to $760 a month coming out of this investment. Lots of times that's enough. Particularly when you start, you're at about 5% of the value each year. So that could be enough. A lot of our clients will also have a Fidelity stock account. So the RMD doesn't have to come out of each account. It has to come out of your accounts. So you can sell some stocks and take the distribution out. So if you only have one asset and it's real estate and it's not cash flowing very well, then you might need to think about selling it or even borrowing secured by it to get some extra cash in there.
If for whatever reason the administrator can no longer perform the function of administrator, what happens?
Then it would go to some other administrator who can.
And in a worst case scenario, let's say there isn't an administrator to take that responsibility, what happens?
World ends.
The world ends. Huh. I've never had that one before, but it is still your IRA, titled in your IRA's name. Then any bank could actually do what we do. They would probably charge more, but
they've been resisting self-directed IRAs for a long time.
yeah.
They don't want any part of it.
We like that they don't like it.
Yeah.
Right. And they don't like it because they don't get enough of them to know what they're doing. So we do this 24/7, it seems like. And so we've seen a lot of strange things, but we know the answer to most questions and can help people out. The investment issue that can come up running out of cash, we can't really help with. We can just tell you what other people have done. And the industry itself is growing significantly. Back in 2003, the amount of money in self-directed accounts was probably less than 0.5% of the total $10 trillion in retirement plans. Now it's probably between 3 and 4%. It's probably the fastest growing segment because so many people don't know about it. And so many people know how to invest in something that's not the stock market. So we spend most of our time educating and doing classes like this. And we have staff people that do it as well. But it's a growing and more important piece of the retirement industry. This is money that you have that you maybe have never thought about for real estate investing. Now you can. And all those factors that made you like real estate in the first place are the same ones that work inside Uncle Ira's account. You have control. There are some rules about what you can't do, but they're relatively minor. after you overcome your sadness of not staying on the lanai and the condo in Maui, you'll think of other investments that might even cash flow better. So for joining us tonight, we do have a $25 off coupon, and surprisingly, no one's asked about fees yet. There are fees, and what we charge is basically paper pushing fees. So to open an account, usually $50. To do a transaction, for a real estate transaction, it's up to $250 for manhandling all that stack of paper and pushing the money out. Annually, there's a $295 charge per property, and if it's mortgaged, it's $490 per year. You can, if you have a whole bunch of really small properties, use a valuation-based method that's a percentage of the value of the account. And then there are transactional charges, like I was saying, if you send us the bill to pay the HOA, there's a $10 charge from that, but if you go online and do it, there's no charge. So it's relatively low compared to what Wall Street charges, but it is on you to do a lot of the work. Yes?
So going back to the earlier question about having multiple accounts, do you get charged an annual fee on each account you have?
Create so.
On each asset.
We have to, each account, so if 4 assets and spread across your 4 accounts would be a piece in each one. So each of those does get a fee, because we have to track them separately and report them separately.
Does the IRA pay the fee? Or?
Yeah, the IRA or the individual can, either one, it's up to you.
In the event of a tax issue, is there defense obligation on your part, or is it up to just the individual to? So if the IRS came in and questioned the investment or the structure of the investment, said, like you said, there's a lot of the rules aren't really written; they're written with a very broad stroke. So
right. We do our best to educate you about what the rules are, and if you bring us something that we can see clearly is a violation, then we don't execute it. That being said, if you do have your IRA invested in an LLC, we don't know what's going on inside the LLC. So the risk is always yours, and that's why we send you, if you're doing something that's edgy, then get an attorney to bless it for you, and that gives you more protection than us. Yes?
Wayne had a question too.
So if you have a number of traditional IRAs out there, could you just roll them all into one before moving it in instead of sending each one individually, so that cuts down the fees?
The fees for moving money in from outside, there are none. So and a lot of our clients do have 3 or 4 IRAs in various places. They'll roll them all into one, and there's no charge for moving funds in. It's just the transaction when we execute something.
So on a practical matter, since a lot of real estate is done after hours, and in your example, the contract needs to be in the name of NewDirection IRA for benefit of the IRA, what happens when it's Saturday night and the market is such that the seller and the seller's agent say that, well, I'm not going to accept your offer because I don't have a signature from you? Is it okay to write it in your personal name and then put it's going to be assigned to your IRA on Monday morning? Or what's your answer on that? Because I've been asked that several times, and I want to see if my answer matches yours.
So the assignment answer is no, because once you have it under contract, it's yours. And moving it from you to Uncle Ira is one of those transactions. So there are a couple of approaches. One is have the client sign it and then have us sign it in the morning, because usually the seller doesn't know that it's not really official until it's signed by us for the IRA. Or write in as a special provision that it will be executed completely Monday morning. Or Catherine, do you have other suggestions?
No, a lot of people do the signing it personally. One of the reasons we like to sign it is because of the titling, that very issue of accidentally putting it in your name. So it's good to have somebody that knows what they're doing. I mean, we have people that have multiple houses and make multiple offers all the time. I would say, for the most part, they sign them themselves, Bill.
Yeah.
Well, you guys said you work 24/7.
Yeah.
I've discovered that my phone has a switch. If I remember to use it, yes.
So when you write the offer, it would be NewDirection IRA DB for the benefit of,
For the benefit of.
and Joe Smith IRA. So then Joe Smith could sign that?
Joe Smith could sign it. It
Okay.
wouldn't be enforceable because he's not an authorized signer.
Okay.
But it
But nobody really knows that.
effectively enforced, because Joe's gonna tell us to do it on Monday morning.
Okay.
And that, with the multiple offer thing, we see a lot of times people just sign them. If it goes through, then they send them over to us. And we put our blessing on it, first signature on it.
Thank you.
All right, so here's our contact info. We're on just off McCaslin in Louisville if you want to come by. We also on our website have a lot of webinars that we've recorded, including ones about unrelated business income tax, which is the tax I talked about, and transactions. If you have a particular transaction in mind, we have staff that can walk you through it. We sort of specialize in that first transaction. A lot of questions are going to pop up because most people have never done it inside their IRA, so we're happy to help in any way we can. And Jay, thanks for having us out. Dwayne, good to see you again.